The day London learned to move money without borders. They didn't announce it. They didn't celebrate it. But the moment it happened, global finance was never the same again. To understand why this moment matters today, we have to return to a time when money was heavy, slow, and constrained by geography. A world where capital moved at the speed of ships and paperwork, and borders defined what was possible. Because the system London quietly built back then is the same system still shaping markets, power, and influence today. For centuries, London was not just a place where money gathered. It was a place where money learned to travel. While other cities focus on wealth, London focused on movement, on flow, on connection. And that distinction changed everything. At first, finance was simple. Money stayed close to home. Banks served local merchants. Risk was personal. Trust was limited by distance. But as global trade expanded, this old model began to fracture. Empires stretched across oceans. Commerce demanded speed, and money needed to follow opportunity wherever it appeared. London saw the problem before anyone else did. If capital could move freely, power would follow. If borders could be softened without being broken, influence could expand without force. And so, quietly, deliberately, London began experimenting with a new idea, money that wasn't anchored to a single place. The earliest signs were subtle. Credit instruments that traveled instead of coins. Insurance contracts that protected ships thousands of miles away. Promises written in London but honored across continents. These were not dramatic inventions. They were practical solutions. But together, they formed something revolutionary. Money was no longer just stored. It was mobilized. By the time the modern world began to take shape, London had already mastered a skill no empire could fully control. It learned how to let money move beyond borders without losing trust, how to connect markets that never met, how to operate between nations rather than inside them. And once that door opened, it never truly closed again. Because when money stops belonging to one place, it starts shaping every place at once. And that was only the beginning. Once money learned how to move, everything else had to adapt. Borders still existed on maps, but finance began slipping between them. London became the place where this transition felt natural, not because it ignored rules, but because it understood how to work around them without confrontation. The city didn't challenge sovereignty. It simply created pathways that made sovereignty less restrictive. This shift accelerated quietly. Banks in London began holding and transferring currencies that were not their own. Deals were settled in one country, cleared in another, and trusted everywhere in between. Money started living in an in-between space, not fully domestic, not fully foreign. It existed wherever confidence existed. At first, this flexibility looked harmless, even helpful. Companies could expand faster. Trade became smoother. Risk could be distributed instead of concentrated. Governments benefited from access to deeper pools of capital. Everyone gained something. And because no single law was broken, no alarm was raised. But beneath the surface, something far more important was happening. London was becoming the switchboard of global finance. When capital moved through the city, it gained a kind of neutrality. Transactions felt safer. Agreements felt enforceable. Disputes felt solvable. Trust followed the money, and the money followed London. Over time, this created a powerful feedback loop. The more flows passed through the city, the more essential it became. And the more essential it became, the more flows it attracted. Other financial centers noticed, but replicating this system was harder than it looked. It wasn't just about infrastructure. It was about legal consistency, cultural discretion, and a reputation built over centuries. London didn't need to dominate markets. It only needed to connect them. As technology improved, the system tightened. Telegraphs replaced ships. Screens replaced paper. Transactions that once took months now took minutes. Yet the underlying logic remained the same. London was still operating in the space between borders, quietly synchronizing a world that was growing faster and more complex. By the late 20th century, this invisible network had reached critical mass. Vast sums moved daily, without ever truly touching the countries they passed through. Currencies flowed independently of national intent. Capital responded less to flags and more to signals. And that's when the tension began. Because when money becomes faster than politics, someone eventually loses control. And the world was about to find out who. The conflict didn't arrive with a crash. It arrived with confusion. Governments began to notice that decisions made far beyond their borders were suddenly shaping their economies. Interest rates shifted without warning. Capital surged in and out faster than policy could respond. Financial pressure appeared without a clear source. Money was moving according to a logic that no single nation fully controlled. London sat at the center of this tension, not as a ruler, but as a conduit. Capital passed through the city with extraordinary speed, responding to signals, expectations, and subtle changes in confidence. Markets no longer waited for legislation. They reacted to sentiment, and sentiment moved faster than law. This created a paradox. Nations depended on global capital, but global capital was increasingly indifferent to national priorities. Governments wanted stability. Markets wanted efficiency. London provided the space where those two forces collided, quietly, continuously, and without spectacle. Crises exposed the fragility. When panic struck one region, money fled instantly to another. When confidence evaporated, liquidity vanished. Entire economies felt the shock of decisions made thousands of miles away. The system that once promised flexibility now revealed its sharp edge. And yet, shutting it down was impossible. Too many systems depended on this flow. Trade relied on it. Pensions relied on it. Governments relied on it. Even critics relied on it, whether they admitted it or not. London had become too embedded to remove, too connected to isolate, too efficient to abandon. Inside the city, institutions adapted. Risk models evolved. Coordination deepened. Informal agreements formed between competitors who understood that total collapse benefited no one. Rival banks shared information. Regulators learned to communicate across borders. Stability became a collective responsibility, not a national one. This was the city's quiet strength, not control, but coordination, not authority, but alignment. While politics argued publicly, the financial system learned to stabilize itself behind closed doors. London became the place where panic was absorbed, slowed, and redistributed before it reached breaking point. But this balance was fragile, because the faster money moved, the less time humans had to intervene. And as automation grew, the system began making decisions at speeds no committee could match. The question was no longer whether borders mattered. The question was whether humans could still keep up. The moment arrived quietly, without alarms or headlines. Money began responding faster than people could think. Automated systems reacted to signals in milliseconds. Capital shifted before explanations could form. By the time humans noticed movement, it had already passed through London and moved on. Borders still existed, but they no longer slowed anything down. This was the true climax of the transformation. London didn't remove borders. It made them irrelevant to money's movement. The city became a place where trust traveled faster than regulation, where confidence replaced control, and where coordination mattered more than command. Stability was no longer enforced. It was engineered. Behind the scenes, systems evolved to prevent collapse. Clearing houses absorbed shock. Liquidity pools softened panic. Informal communication between institutions slowed reactions just enough to prevent chaos. These mechanisms were never designed to be visible. Their success depended on remaining unnoticed, and most of the time they worked. When markets trembled, London dampened the vibration. When confidence wavered, the city redistributed risk. When panic threatened to spread, invisible systems absorbed pressure before it reached the surface. The world saw volatility. It did not see the machinery preventing disaster, but this achievement came with a cost. Power shifted away from borders and toward systems. Influence moved from parliaments to platforms. Decisions affecting millions were shaped by flows few people understood. Money no longer waited for permission. It moved where it felt safest, fastest, and most trusted. And London became the place where that trust lived. Today, every global market still depends on this architecture. Every crisis still tests it. Every innovation still builds on it. The world runs on money that no longer belongs to one country, one law, or one authority. What began as a quiet solution to a practical problem became the foundation of modern finance. And once money learned to move without borders, there was no turning back. Subscribe to join the journey. The day